Did you know that the world is now drowning in a staggering $324 trillion of debt? That's more than 4 times the entire global economy. This isn't just a number. It affects your everyday life, from the price of groceries to your mortgage. In the next few minutes, we'll break down why global debt matters, how it impacts you, and what you can do to protect your money before it's too late. If you want to stay ahead in today's unpredictable economy, make sure to hit that subscribe button and turn on notifications. Don't just watch. Take control of your finances, plan smart, and protect your future. And if this video helped you understand the risks of global debt, give a thumbs up and share it with friends and family who need to know this too. Global debt has reached an all-time high of $324 trillion, a number that far surpasses the total global GDP. To put this into perspective, the world collectively owes more than 4 times the value of all goods and services produced in a year. This staggering figure is not merely a statistic. It reflects fundamental trends in how modern economies function and how governments, businesses, and individuals increasingly rely on borrowing to finance growth, social programs, and lifestyle consumption. The roots of the current debt crisis stretch back decades, but the acceleration has been particularly pronounced since the 2008 global financial crisis. During that period, governments and central banks around the world took unprecedented steps to prevent the collapse of financial systems. Central banks slashed interest rates to near zero levels, making borrowing cheaper and encouraging spending and investment. At the same time, governments launched massive stimulus packages to support businesses and citizens. These measures successfully stabilized economies at the time, but they also entrenched a reliance on debt as a primary economic tool. Debt is not inherently bad. When used strategically, it can finance infrastructure, healthcare, education, and business expansion. However, the current scale of borrowing raises serious concerns about sustainability. Nations like the United States, Japan, and parts of Europe are carrying debt levels that are historically unprecedented. Even emerging economies are accumulating debt rapidly, often denominated in foreign currencies, which exposes them to currency risk and economic instability. Corporations have mirrored this trend. Many businesses have taken advantage of historically low interest rates to borrow extensively, financing mergers, acquisitions, share buybacks, and expansion projects. While this strategy can boost short-term profits and shareholder value, it also creates vulnerability. Highly leveraged companies are much more sensitive to changes in interest rates and economic downturns, which can trigger layoffs, reduce investment, or bankruptcy in extreme cases. On the individual level, household debt has also surged globally. Mortgages, credit cards, student loans, and personal loans are common, especially in developed economies. Easy access to credit encourages consumption, but also increases vulnerability to economic shocks. When interest rates rise or incomes stagnate, households may struggle to meet repayment obligations, affecting their financial security and overall economic stability. The cumulative effect of these trends is a global economic structure built on debt dependency. Countries, corporations, and individuals have become intertwined in a complex web of borrowing, where failure of one segment can have ripple effects worldwide. Every dollar borrowed adds risk, and the scale of current debt suggests that the global economy is walking a precarious tightrope. Furthermore, demographic changes intensify the problem. Aging populations in developed nations increase government spending on pensions and health care while shrinking the workforce, reducing tax revenue. Younger generations often enter adulthood burdened with student loans and housing debt, limiting their ability to save and invest. The combination of rising public debt, corporate leverage, and household borrowing creates a system vulnerable to shocks, whether from economic crises, geopolitical conflicts, or pandemics. In conclusion, understanding why global debt has grown so rapidly requires a multi-layer perspective. It is not simply the result of overspending. It is also the outcome of systemic economic strategies, historical crises, and structural dependencies. This backdrop sets the stage for understanding why the current debt level of $324 trillion is not just a number. It is a signal of potential economic stress that can impact every individual and institution across the globe. While $324 trillion may seem abstract or remote, the reality is that rising global debt has tangible consequences for everyday life. At the macroeconomic level, high debt can fuel inflation, When governments borrow excessively and finance their obligations by printing money, the money supply increases, which can devalue currency and drive up the cost of goods and services. Inflation erodes purchasing power, meaning that households may need to spend more for the same necessities, from groceries to fuel. Interest rates are another channel through which global debt affects daily life. Central banks monitor debt levels closely because high public and private debt can limit monetary policy options. If inflation rises, interest rates may increase to curb spending. Higher rates directly impact mortgage payments, car loans, and credit card balances, putting pressure on household budgets. Individuals carrying variable rate debt are particularly exposed, as their repayments may rise unexpectedly, reducing disposable income and savings. Corporations are also affected by the global debt environment. Highly leveraged companies are vulnerable to market volatility. In periods of economic stress, they may reduce spending, delay projects, or lay off employees to manage debt obligations. This behavior can have a cascading effect. Reduced corporate spending slows economic growth, job insecurity rises, and consumer confidence declines. For investors, debt-laden companies represent higher risk, potentially impacting stock markets and retirement portfolios. Public debt plays a particularly critical role. Governments with high debt levels face limited fiscal flexibility. In the event of an economic downturn, natural disaster, or global crisis, these governments may struggle to implement stimulus measures without exacerbating debt problems. The result can be a choice between raising taxes, cutting social programs, or reducing public services, decisions that directly impact the population. Citizens may experience higher living costs, fewer public services, or reduced support during difficult times, highlighting the interconnectedness of global debt and personal well-being. International debt obligations also create systemic risk. Many countries owe substantial amounts to foreign creditors. Currency fluctuations or geopolitical instability can increase repayment costs, leading to crises that transcend borders. Historical examples, such as the 1997 Asian financial crisis or the 2010 European debt crisis, demonstrate how excessive borrowing can trigger regional and even global economic disruptions. Even in stable economies, the psychological impact of debt is significant. Awareness of high national, corporate, and household debt can influence consumer behavior, often reducing spending and investment due to fear of financial instability. This creates a paradox. Debt is intended to stimulate economic growth, but excessive debt can suppress growth through uncertainty and caution. Finally, global debt has long-term implications. The intergenerational burden is real. Today's borrowing often becomes tomorrow's obligation. Young adults entering the workforce face higher taxes, reduced government support, and potentially slower wage growth due to the financial constraints created by previous generations' borrowing. This cycle reinforces inequality, limits upward mobility, and creates social tensions that can affect political stability. In essence, the impact of global debt extends far beyond balance sheets. It touches daily life through inflation, interest rates, job security, government services, and long-term financial stability. Recognizing these effects is crucial for individuals, investors, and policymakers who must navigate a complex economic environment shaped by $324 trillion in debt. Understanding global debt is not just an academic exercise. It is a critical tool for personal financial preparedness. The reality is that $324 trillion in global debt affects everyone, regardless of nationality, profession, or income level. Economic instability in one part of the world can quickly ripple outward, influencing interest rates, investment returns, and job security worldwide. The first step in preparation is awareness. Individuals should assess their own financial situation, particularly their exposure to debt. Maintaining manageable levels of personal debt, avoiding high-interest loans, and planning for emergencies are essential strategies. Diversifying income sources through side businesses, investments, or skills development can also provide resilience against economic shocks caused by global debt crises. Investing wisely is another crucial approach. In volatile economies, traditional investments may carry heightened risk. Allocating a portion of savings to safer assets, such as government bonds of stable countries or diversified global funds, can help mitigate risk. Awareness of how debt levels influence market trends allows investors to make more informed decisions, protecting both short-term income and long-term wealth. Governments and policymakers also have roles to play. Citizens who understand the implications of high national debt can better evaluate policies, taxation, and public spending initiatives. Informed electors are more likely to support sustainable fiscal strategies, avoiding policies that could exacerbate debt problems and threaten economic stability. On a broader scale, global debt underscores the importance of financial literacy and education. Understanding how borrowing, interest, and fiscal policy work equips individuals to navigate economic uncertainty. It also encourages responsible behavior in personal finances, corporate decision-making, and civic participation. The key takeaway is that global debt is not an abstract concept. It has real-world consequences for individuals, families, companies, and nations. By staying informed, planning strategically, and maintaining financial discipline, people can protect themselves from the ripple effects of debt crises. In conclusion, $324 trillion in global debt is a wake-up call. It highlights the interconnectedness of the modern economy and the risks inherent in excessive borrowing. Awareness and preparedness are essential. By understanding the scale of the challenge and taking proactive measures, individuals and institutions alike can navigate an uncertain economic landscape, safeguard financial well-being, and contribute to a more resilient global economy.